Welcome back to the Krown crypto channel, and today we will be going over the call option. Now, I do want to preface this whole conversation by saying that when we go over the dictionary definition of a call option, or a put option for that matter, as we will get into another video, do not fear if the definition goes straight over your head. For myself, it certainly did. It really took me a lot of hands-on examples that actually solidified and then cemented the understanding of it within my own brain. So we'll be doing that, of course, within this video and throughout this series. But first and foremost, well, what is a call option? For this, we will go over here to trusty Investopedia and just read straight off the dictionary right now. Call options are financial contracts that give the option buyer the right, but not the obligation, to buy a stock, bond, commodity, or any other asset or instrument, Bitcoin in this case, at a specified price within a specified time period. That last portion there, very key, however. The stock, bond, or commodity is called the underlying asset. A call buyer profits when the underlying asset increases in price. Here's the thing though, and what they didn't tell you on Investopedia is that you can not only just buy or long call options, you can also sell or short call options. And in this case, we should first define, well, where do you actually find your call options on the good old bingo board right here? It's almost always, in fact, in my experience, it's never not been on the left-hand side. And of course, this represents all of the different strike prices, and then the actual market itself, bid and ask, that is really only going to be liquid here at the monies, because these are expiring, I believe, today. Yeah, they are expiring today. So let's maybe go to Fridays, actually. And there we go. We actually have some markets here. That's good. So we'll actually take tomorrow's expiration. Is the $23,000 strike. That is the closest to current price, as price is currently trading at $23,030 on CME right there. So going back to our ByBit exchange here, we can effectively say that, hey, that is the at the money strike. Okay, so let's go over some colloquial definitions, not to be confused with the Investopedia definition. Basically, if you are long or holding a call option, then you are effectively bullish on price. And if you are short a call option, I would not necessarily say that you are bearish on price, but you are essentially not bullish on price going above a certain level, let's say. With all of that said, looking at options in terms of bullish or bearish is actually, in my opinion, a fool's game and not very wise unless you're combining it with spot positions. If you're trading options, or especially options versus options, what we're really looking to do is volatility plays. That's where you can have a major edge in these. But for the purpose of thoroughness here, I want to go over some examples that I think will help a lot more with understanding these things. First, we'll go over an example of what your P&L graph, your P&L curve will look like if you bought an option. Now, for this particular instance over here, I just pulled up a chart that I found over the internet. This is relevant to U.S. markets, which have settlement in American terms, which is different than ByBit. ByBit settles in European terms. We'll go over what that means later. It's not important for right now, so this will be slightly different here. But basically, when you are long a call option, you essentially need price to go above the strike price that you chose. In this case, we would say $23,000 plus the premium paid for that option. The premium that you pay for the option is just the price that you buy the option for in this case. As you can see here, if we go, and let me just double check. Yep, we have bid and ask. You will notice that the current best bid on the at the money $23,000 strike is $300, and the current best ask is $320. Let's just say, for simplicity's sake, that we can make this just $300, because I'm going to do an example and I don't want to break my brain doing math at a first grader level. So in this case, we're going to take an example here where we long one contract. We bought it for $300 call contract, and our strike price is $23,000. So within the context of this example, where that 100 would be $23,000. That is our strike price. The $300 paid for premium would be the actual price of the call, which is just doing the example right here. And of course, the strike is going to be 23. And then of course, our break even will be the strike plus the premium paid. So in this case, it'd be 23,300. That is to say that if you bought this call, which expires tomorrow, that being Friday, as this video is being recorded on Thursday, you probably won't know that in the future, it's just be uploaded at a much later time, that unless a price action closes at expiration above 23,300, you will lose. That is also to say, until price action goes above 23,300 by expiration, you will then make an equal amount for every contract for every dollar above the premium plus strike price. So if price closes at 23,301, you'd make $1 if you hold one contract. Okay. So there we have it right there. Your max loss is just what you paid for the contract. In this case, that would be $300. That represents this right here. Obviously not 200 in this case, but you can see that your potential profit is unlimited. This is why, and I'm kind of speaking offhand here, but this is why I believe that the public, the general public, typically likes to play options, because they look at it as a way to gain extra leverage and basically play the lottery. You know, we saw a lot of that with Robinhood recently, and I suspect that we'll see a lot of it more in the future as well during the next boom and bust cycle, of course. But in this case, I would go as far to say that, personally speaking, I never buy naked options, that being calls or puts for that matter. It always has to be supplemented with an option on the other side to kind of even things out and go for either a volatility play, or what I'll typically do is pair it up with spot price action, and that way we can do other more advanced strategies with covered calls and covered puts, which are not that advanced, but they can get rather complicated if you start to put on many legs. Anyways, in this case, I hope that this can really shore up your own visual understanding of what a long call would look like. We can do another example as well. Let's go back to the bingo board here. Let's say that we wanted to buy a slightly out of the money call, meaning that the strike price that we're going to pick is above, well above perhaps, where current price action is. Current price action, again, $23,000. And if we were to say, if we were going to pick, let's say, the $24,000 call strike right here, you'll notice that the market for it is much smaller, meaning that the price that people are willing to buy or sell it for is much less than the at the money. Naturally speaking, because price action has to go a lot further in order for it to be in the money. So in this case, let's say, again, for simplicity's sake, we can buy this option for $50 right there in the middle of this market, which is actually a good representation of what they're typically worth, just marking it to the middle. And so if we bought this $24,000 call strike for $50, then where is our break-even point? I'll just stop here for a second, and I'll just fill it out over here. All right, so our strike is 24. Oops, there we go. The price that we paid, $50. What's our break even? Well, not 350, but 350. There we go. 24 and 0 and 50. That means by expiration, we do not make money until price action goes at least one tick above 24,050. Anything below there, and we start to lose. Of course, when price action gets to the actual strike, or if it's anywhere below the strike, we just lose the full price of the call. And between the strike price and the break even, you know, it's a little bit less than that, dependent upon the actual price of the call. And obviously, our max loss in this case is $50. But the thing is that people will look at this and they'll be like, "Oh man, I can play the lottery for $50 here, and you know, maybe this time it works out." Sometimes it does. Most of the time it doesn't. In fact, I believe 80% of options, it's either 70 or 80% of options typically expire worthless. Just a nice little statistic there for you. Okay, but here's the thing. You don't just have to, or you don't have to do anything, but you are not limited to only buying call options. You can also short or sell call options as well. As you might imagine, the people on the red hand over here, those are all sellers, of course. That could be you too. So what is the difference between buying or selling a call? Well, if you're buying a call, you're effectively bullish on the underlying, or you're long volatility, to be fair, which is probably more likely. But if you sell a call, are you necessarily bearish? You are not, in my opinion. The reason why I say that you are not necessarily bearish, in my opinion, is simply because if you were bearish, it would be much more effective to either short the underlying, so short Bitcoin in this case, or using like just, futures contracts, or buy a put. If you're going to short a call option, you are limited only to the premium that you sold it for as your potential profit, and you actually have potentially an unlimited loss if price action trades against you. So let me just show you an example of what the P&L curve would look like in terms of selling an option. So the price that you sell it for, that's your max profit. In this case, or in this example that I just pulled randomly off the internet, was $500. So the call option cost 500. And the strike was obviously $100 right here, and the break even was 105. So yeah, it cost $5. This is American style, so it's times 100. I don't mean to confuse you with that, but let's just do a quick example with this. I'm going to fill out the same criteria right here. Okay, so we're going to go strike. Oops, strike. Price of call, break even, max profit, max loss. Okay, well, max loss we already know is infinity, because if price action trades against you, then, well, it can theoretically go to the upside for forever. So you do have a theoretical maximum loss of infinity. But let's take an example over here. So let's go back to the $23,000 strike. The at-the-money strike right here is typically the most liquid. And we're going to just, again, for argument's sake, for simplicity's sake, we're going to say it's worth $300. We sell it to someone for $300. Sorry, but that's your problem. So we are going to pick the strike, 23. Price of the call, we're going to sell it for, I believe it was 300. Yep. What's our break even? Okay. What's the break even? Well, it would be the strike price plus the call, the price of the call. So that would be 23,300, meaning that if price action rallies from here to 23,300 by the end of the expiration period, which is actually tomorrow, then we will make nor lose $0. Again, we sold it for $300. The strike was $23,000. Price action goes to 23,300. We make and lose nothing. But here's the thing: because you sold that call option for $300, you actually basically get to benefit by pocketing that $300 as long as the price of the underlying is below the strike price by the end of the expiration period. So your maximum profit in this case is 300. Maximum loss, as you know, is infinity. And, well, yeah, that's rather concerning. So you should have your risk management, of course. Playing naked options, in my experience, is not a good idea. Just personal experience here. So in this case, we are 13 minutes into this video. I do want to preference the next video with a put by saying we can essentially flip all of these in a way to fit the narrative of a put. A put is going to be an option to sell at a specified price rather than buy at a specified price. So we will get into that one into the next video, and I will see you there. Take care.